Hiring in the U.S. labor market also stalled in August. Some jobs were added, but it was just a rounding error, 22,000, well below expectations. Investors now turning their attention to U.S. CPI data for August, and that is due on Thursday of next week. Slowing price growth, slowing inflation could cement expectations for at least one rate cut this month and maybe more. Let's get perspective on how the Fed will respond. We're joined by Chris Brigati, Chief Investment Officer at SWBC. Thanks very much for joining us, Chris.
Thanks for having me.
Let's get the obvious question out of the way. Do you think the Fed will cut September 17th?
I think it's a foregone conclusion at this point. I had been one of the holdouts that they probably wouldn't up until relatively recently, and I had changed my opinion as the facts had started to change. This data point this morning really solidifies the fact that 25 basis points is nearly a foregone conclusion.
You say that specter of stagflation is hanging over the economy. It sounds so nasty, doesn't it? A moribund growth, but high inflation.
Yeah, it's kind of the worst case scenario for the U.S. economy if we do have the slowdown, but inflation does remain sticky, and worse than that, head higher. That brings in stagflation, which is really kind of something that makes it very, very difficult for the Federal Reserve to manage through. So very cautious about that. It's an outside chance at this point. My base case scenario is still a soft landing, but we have to be aware that if the economy does cool, we could present a stagflationary environment.
I mean, stagflation sounds contradictory, doesn't it? A weak economic growth, but companies or providers have the power to increase prices?
Yes, correct. And it's really a matter of what's going on with interest rates and the economy in terms of struggling through how the pricing scenario can really work for or against those consumers and ultimately the distributors and suppliers of commerce. So in the long run, it does present a very difficult situation for the economy, and I'm very wary that that could persist.
Yeah, I mean, I'm just thinking about things like healthcare. The costs seem to rise relentlessly there. So I guess health insurers try to pass on the cost to their consumers, et cetera. There's always a knock-on effect with price increases.
100% accurate, yes.
Talk to us about what sectors of the market you think investors should be overweighting right now.
I think there's some opportunity given a rate cutting environment. So as we're heading to that, certain sectors of the S&P 500 tend to perform fairly well. And one of those is financials, which we've had good, strong performance thus far this year. And in an environment where there's interest rate cuts, especially watching this curve steepening that has happened so far this year, that benefits financial services companies, banks that can make more spread on lending versus borrowing, and therefore they can do very well in this environment. Another opportunity is also the small cap. Small caps tend to do well when we start seeing rate cutting cycles because then their borrowing costs are going down. They tend to have to tap the market to get funding for their expanding their businesses. So there's opportunity there. We had a nice strong performance last month in the small cap space, but now that we're entering a definitive rate cutting environment, I do think there's room for that to expand.
I'm just trying to think, are there areas of the market you would avoid? I think you're a little wary on these Mag 7 stocks that have had such a gallop.
Correct. I mean, they've done very well. They're leading the S&P. They represent a significant portion of the S&P growth thus far this year. So a little bit wary that they're getting a little toppy. Not saying to sell, but just be aware that we could see a little bit of toppiness in the Mag 7 given the overall growth and trajectory they've had thus far this year. And if we do see a pullback in the economy, the Mag 7s had led the way up. They'll likely be leading the way down as well.
And you think that, just to turn to the bond market, you think that there could be excessive optimism there in that people are demanding pretty narrow spreads before they buy corporate bonds versus treasuries?
Correct. We've seen quite a narrowing of the corporate bond space, both in IG and high yield. So the performance has been solid. That's a good thing. The caution to looking forward is if there's a downturn in the economy, being aware that some of those corporate credits could have a wider spread widening, which could eat into the relative performance. The bonds could still go down in terms of yield up in price, get decent performance, but there might be underperformance. So it's just being wary of where there could be underperformance in one portfolio. And given the spread tightening that we've seen and the relatively narrow spreads in corporates, there could be room for that spread widening to occur.
Chris, thank you very much for joining us.
Thank you for having me.
Chris Brigati, Chief Investment Officer at SWBC.